Hello, everyone. Welcome back. Yes, I know it's been a long time since our last video. I've been traveling as always. I guess that's just a regular excuse that I use, but hopefully, you all have had a great last couple of weeks. And obviously, there's lots to talk about. What a year 2025 has been. I think it has some highs, some lows. Obviously, some incredible projects have come online. But we're ending the year with a bit of pessimism, overhang, markets overhang, margin squeeze, etc., etc. So that's always not a good way to start a new year, but let's just see how 2026 pans out. What I want to talk today about is actually a bit more focused. I want to talk about the impact of falling oil prices. We talk about LNG a lot and LNG prices, but we forget how important and what a long big driver oil prices actually are to our business. So the topic today, a little bit more macro view of what's going on, but really to discuss oil prices. As you see, oil prices have dropped quite a bit in 2025. Brent has dropped 27% in 2025. And that's a fairly big deal because it didn't start off at a very high level either. And now we are bouncing around, 50, $60. That's not really that great of a price to really get LNG projects off the ground and make a lot of money for LNG producers. And that's reflected in stock prices. Just the few pure play stock prices in the US, LNG, which is Cheniere has dropped about 20%. Cheniere has dropped about 10%. Next decade has dropped about 20% this year. And Venture Global, has its own issues, of course, I won't get into that, has dropped about 75%. So it hasn't been a great investment into LNG for equity investors in the listed market space. I think that the private space is doing a lot better. And that's why we see a lot of projects getting to FID. But what do falling prices really mean? Now, before I get into that falling prices, let's be clear. Oil prices are notoriously hard to predict. What is 2026 going to be? No one knows. And the reason oil prices are very hard to predict, in my view, is because it's not driven by supply and demand as much as driven by politics. If OPEC and the rest of the producers want to produce more, they will, and oil prices will drop. If countries decide to pursue more low carbon strategies, oil prices will rise, oil demand will drop. These are all very political type of impacts, and thus it's very hard for us to sit and predict oil prices, and no one can really predict it. Now we all are hoping that oil prices will go up from current levels around $60 to about $90, $80. That's kind of a better level for us to be for LNG producers. So let's kind of break down all the impacts that low oil prices have on our industry. The first is kind of fundamental. Let's go back to the upstream. So much of the gas produced today is what we call associated gas. That is gas produced in the reservoir as you're producing liquid hydrocarbons, typically oil, sometimes NGLs and condensates. So gas is a byproduct. Now, of course, gas is very valuable by itself, but gas's economics are greatly influenced by the main product in the well, which is oil. This has a big impact on places like the Permian in the US, where most of the gas is still associated gas. If oil prices are low, as they are, oil producers are less likely to drill new wells, less likely to produce their oil wells. When you're less likely to produce the oil wells, you will have less associated gas. So there is an impact that we could actually see less gas in the market, less feed gas, less gas in the pipelines in the US and other places as well. That depend a great deal on associated gas. West Africa depends on West Africa depends on associated gas. Lots of Southeast Asia depends on associated gas. These are all going to have an impact. If there's less feed gas in the market, that's going to potentially drive the gas price up, feed gas price up, and that'll make LNG producers have to pay more for the feed gas, and that could then hurt the economics of the LNG produce. Just related to this, if oil prices are low, there's less of an incentive for oil companies to go out there and drill exploration wells. Typically, oil companies go out and drill oil exploration wells because gas is notoriously hard to commercialize. So when you find these discoveries in places like Guyana and Suriname and all these frontier places, Tanzania, today there's gas fields there, but they were not looking for gas. The big companies are typically not looking for gas. Mozambique was found because they were looking for oil and they found a lot of gas. So if oil price is low, oil companies, first, they have less money because they're earning less, and less, secondly, they have less incentive to go out and drill high risk exploration oil wells. And because they drill less oil wells, they find less gas as well, because typically no one drills a frontier gas well, they drill frontier oil wells, because history has shown that gas in stranded areas, in remote areas, can take 20, 30, 40 years to develop, if ever, while oil can be brought online very quickly. So from oil companies' point of view, why should they go out and find a mega gas field in Tanzania when they can hopefully find an oil field and commercialize it much quicker than a Tanzanian LNG project, as we know, drags on for decades and decades. So there's less gas exploration, there's less associated gas. This all impacts the price of feed gas that goes into an LNG plant or into a pipeline system. So, so much of the world, let's go now and move to shift to post LNG production. A large part of the world's LNG is still linked to oil prices. That's how LNG is sold. All the LNG sold by Qatar, for instance, and most of Southeast Asia is sold on oil linked prices. So, what does that mean? That means that the price of LNG that a consumer in Japan might pay is a percentage of an oil price. Yes, I realize these are completely disparate commodities. It's like pricing bananas on the price of oranges. It makes no sense. I'm against it. I've always have been against it. But that's a reality, especially in Asia. Now, Europe used to be also very much oil linked. It has weaned itself away from the oil link in the last couple of decades, and now it's more gas linked. So there is less of a link directly to oil price. Having said that, many producers, such as Nigeria, such as Qatar, such as Angola, such as Oman, you keep on going, that sell into Europe still sell it on an oil linked basis. So when oil prices go down, LNG prices go down. So those current producers will earn less dollars for their LNG. That's just the way they bet on oil, and they bet that oil is going to go up. And when oil doesn't go up, that's a problem. Asia is still predominantly an oil linked market. Asia is the fastest growing LNG market, the fastest growing gas market. Nearly all the pipeline gas that's sold in Asia, especially from Russia and transnational pipeline gas, is linked to oil price. So those prices are going down quite a bit as well. Consumers are loving it. Consumers are getting a double bonus. They're getting low oil price, which helps the economy, transportation, etc., and they're getting low LNG, which is linked to oil price. And that's that LNG is getting used for other sectors such as power generation. So those consumers, especially China, Japan, India, Malaysia, Indonesia, all these places are actually benefiting a great deal from low oil price. But on the other side of the coin, the people that are going to suffer are the LNG producers, because a lot of them have done very expensive expansions. A lot of them are continuing to make expansions. A lot of them building greenfield projects based on certain oil price assumptions, which are then linked to certain LNG price assumptions. It is hard to sell umbrellas when it's sunny outside. What does that mean? That's my little phrase that I like to use. It's hard to convince people that oil price is going to be higher and they should buy a long-term contract on a higher price, oil link price, than it is today. In other words, if oil is $70 and you're selling a gas at maybe 12% link, the gas price is $9 or $8 or $9. It's hard to convince people, well, in the future, oil is going to be $90 and we should plan accordingly. It will be, it's a cyclic, everything goes up, everything goes down. But people look out of the window and they're saying, I don't need an umbrella today. I'll worry about the umbrella when it starts raining. So, how does that translate to all of this? It's going to be harder for people to get new projects off the ground, especially in places that sell oil linked contracts, such as Timor, Papua New Guinea. All these are new projects in Australia, new projects in Africa, Mozambique, Tanzania. All of these, the project economics are going to be based on certain oil price assumptions. And it's harder to have higher oil price assumptions when oil is at $70. They'll say, oh, oil could be $100, and that's why let's do the project economics as that. But in the end of the day, people look out and say oil is 70. I don't know if it's going to get to 100 anytime soon. If it's already 100, it's easy to justify that. So I see less FIDs for greenfield projects in Asia, in West Africa, in East Africa. It's going to be much harder to get those projects off the ground. South America, even. How does this translate to the US? Well, the US is facing a double whammy. Feed gas prices are going up. Yes, they've come down in the last few weeks, but they saw it high as $4 or $5. CapEx is gone up dramatically. 40% was the number I heard a few months ago. It could be higher. We are seeing way too many FIDs at the same time in the same place. In a geographic radius of a couple hundred miles, we are seeing, 50 million tons of new projects, both in the Lake Charles, Texas, East Texas area, and then maybe around the Plaquemines and New Orleans area, and then in South Texas. Too many projects at the same time means there's going to be a pull on resources. Labor is going to go up, materials are going to go up, suppliers are going to charge more. And we have seen this story before. Projects get delayed, projects cost overruns, and things start getting ugly. And 2025, unfortunately, was a really, really optimistic year for FIDs. And that means that we're going to see the next few years, at the same time where we're going into the next few years with low oil prices, we're actually seeing higher cost, dramatically higher cost in many places. And we're going to see margins squeezed, and that's going to be tough. So projects that are coming online now that may have had a lower cost basis, they could be okay. But Golden Pass coming online now, it had massive cost overruns. It has massive delays, 2-3 years. They're not coming online at a great time. They're going to try to, in that project, it's Qataris and the Exxon going to try to resell the gas. They're going to struggle because the gas market they're going to try to resell into, Asia predominantly, is going to be enjoying lower LNG prices long term contracts because of the lower oil price. Because these regions are having a lower oil price environment, which means a lower long-term LNG contract environment, they're less reluctant to sign more expensive long-term contracts, and spot price, which is completely reflected on the price of the day, is going to be lower. So if these guys such as Golden Pass and others are expecting a windfall with high spot prices, it could be tough. And as we know, LNG is a global market. What happens in Asia is going to impact what happens in Europe as well. So LNG price oil price has a direct link on how many FIDs happen, and the projects that are coming online now has a direct impact on what price they're going to try to get with their contracts. And if they're relying on the spot market, it's going to be a lower spot market, and it's going to impact in the longer term, the optimism around LNG, I think, in the short term. Now, another thing that we often forget is so much of the new money that's coming into the industry has come from the Middle East sovereign funds and the Middle East energy companies, Abu Dhabi, Qatar, to name a few, Aramco through MidOcean, etc. Those companies' main income is selling oil. When oil price is low, they're going to have less funds to invest in projects. the country's sovereign wealth funds, such as the Saudi Arabia Sovereign Wealth Fund and no Norwegian Sovereign Fund, the Qatari Sovereign Wealth Fund, these guys are going to also have less money. A lot of the countries' budgets are based on high oil prices. And when oil prices are lower than their budgets estimated them to be, these countries are going to start clamping down on spending, and they may start reducing their overseas investments into energy projects in places around the world. Abu Dhabi suddenly invested a massive amount of money in Argentina, maybe a good investment, but there is no historical link between Abu Dhabi and Argentina, as far as I know. So the only bringing to the table is money. And where that money is dependent on Abu Dhabi's earnings of oil, there's going to be less money to invest in projects in Argentina and other places like that. So I paint kind of a dark picture. However, there's kind of a double edged sword as well. Yes, in the near term, as oil price is low, we're going to see a less fuel switching. Less fuel switching away from oil products into LNG products. LNG competes with diesel in power generation, fuel oil in transportation, and also power generation. Those prices, diesel and fuel oil prices, go down because they are obviously produced from oil. It's harder for customers to say, I'm going to now flip from diesel to LNG because there's a cost advantage in LNG. That's not going to be there in the near term. However, in the longer term, we may see the demand of LNG go up because LNG prices are lower. As LNG prices are lower in the longer term, and people get confident that LNG prices will stay low, there may be more of a push to build gas-fired power stations in India to clean up the air. There may be more push to start using CNG for cars in other parts of the world. There may be more push to keep the gas as the main fuel for refineries and for petrochemicals, as opposed to using oil-based products, because LNG price is low. So in the longer term, we may see the growth in the market. That's always been our saving grace. Look, when oil price is low, LNG price is low. We hurt in the short term, but the long term, we encourage more people to use LNG because LNG is cheap, and we grow the market. But in the short term, I think this 2026 could be tough. Now, of course, as I said in the very beginning, oil prices are notoriously hard to predict, and it's politically driven. If OPEC and other people, and there's another war or whatever happens, Venezuela blows up. I mean, I don't know. I mean, it's all politics here. Oil prices spike, LNG prices spike, and we are back to where we were before. But the bottom line is, at a $60 oil price, it's really hard to get new projects off the ground, LNG projects off the ground anywhere in the world. And it's hard to convince people that a new project that requires a break even of $90, $100 is going to be viable when they look out the window and it's $60. So, not to throw a dampen on things, but we're going into a very mixed new year. Oil price is low, capex is high, lots of new projects on the board. I think, as I said myself, Gulfstream is a great time for us because we are just looking at getting the permits right now, and we're going to time our FID when the FID time is correct. We are in no hurry to get to FID. We are talking to partners who potentially have their own integrated value chain, so we can get the market kind of away from the open market and have a integrated supply chain that will help insulate us from these volatility in commodity prices. But for projects that need to get to FID very soon, the projects that are very difficult, expensive, Alaska, Mozambique, etc., Papua New Guinea, it's going to be a tough year to see much happening. So, on that note, Happy New Year. Hope all is well. Happy to take any comments on if I missed any more impacts of low oil prices. I hope we see equity markets for the three listed LNG companies Cheniere next decade and Venture Global go, rebound, because when the rest of the stock market has done so well and these projects, these companies have done badly, it makes it harder to attract new equity investment. But remember, this is all a cycle. What goes up must come down. What goes down must come up. Happy New Year, great festive season, and we'll see you all in